Hi, this is G-Man Trading Community. My friend, you have come from far. This is CFD trading. That's when I said that it is not a walk in the park. I really mean it. Because this was an introduced system to help you to trade on price movement in the financial industry. And as far we have come, now we know how to measure the distance. We know how to categorize ourselves using the lots, which was introduced just to categorize the amount of money that could be moving in the market. We have joined the PIP value with money, and we have seen the magic that it can do. And today we are want to unbox a gift that was given to us in the retail industry, retail blocking industry. So let's go on. Let's dive in and see what was given to us as a gift and to open doors for us. Do you know that the lots categories which were brought up by retail brokers were still too big for people? Do you know that those lots were still big for people? Imagine $1,000 minimum deposit. It's a lot of money, and the market needs people. So you can see, maybe you are in Kenya. You know, in Kenya, $1,000 is equal to 100,000 Kenya shilling. So it's a lot of money. Not a lot of people could manage to be in this market if this could be the required deposit in the market. But remember, as I have been saying, in the retail industry or in the CFD, people are needed so much, because to create something called imbalance, for your market or your position to be executed, they need someone against your position, something called hedging. So as we go on, we'll see how broker used to do it back then. They used to do hedging, whereby if I open a buy position on a particular pair, they should take the other side of the position. Meaning that any deposit that is in my account, and I know the system, if I open a position, it goes on my favor, then the money that will be in profit, it must come from someone else's pocket, and that is the broker. And if the broker doesn't have a lot of money, then it should have a lot of people, so that when my position is on profit and someone else is in loss, so I will take that money. And when someone else is in profit and I'm in loss, someone else should take my money, because this is not the real market. It's the shadow of the real market. This is not the spot market, because it is speculation. As we said, we don't interact with the real asset. We don't interact with money directly, but the systems are the same. The price changes are the one which are in the spot market. There's no difference. The only difference is that we don't interact with the real market, so we are in another system, and we can see the hassle that we have gone just to understand it. That's why a lot of people don't understand this market, and that's why I enhance so much to teach the system itself. Because when you know that you are betting, for example, your heart is on a state that you don't conflict with yourself, you don't beat yourself when you are wrong, because you know you are in a game of chances. When you do any kind of analysis, at the end of the day, you have to choose a direction on the position that you'll take in the market. You have to choose the position. But when you're in spot market, even I myself do trade in the spot market. I don't even just look at the price. I look at the history of the company, and I look at the future of the company, and then I buy. I don't look a lot of things. But in the CFD industry, you have to look where the charts, you have to look at a lot of things which you will see as we go on. So we could see now you needed $1,000 so that you can trade in the financial industry, and not a lot of people were in this market because of this limitation. but there's something that was introduced. So the broker had to come up with another mechanism to add numbers in the CFD, and it's called leverage. This was what was introduced so that a lot of people could be added in the industry and the market could be more liquidity. So when the market moves in the spot market, then people will take directions. People will open a lot of position, meaning that when they open position, that is money that is flowing in the market. So you are probably wondering how a small investor like yourself can trade such large amount of money. Think of a broker as a bank who basically fronts you $100,000 to buy a currency. All he asks for you is that you give him $1,000. Now this is the simplest way we can explain. So the broker is like virtually giving you amount of money to help you, to help your small deposit of maybe $1,000 to meet the requirement that is needed in the market. Now I think when we go on, you will understand. So this is like a loan. So let's go on. As a good faith deposit, which he will hold you for but not necessarily keep. So sounds too good to be true. Well, this is how forex trading using leverage works. This is how it works. So the leverage is like an amount you are being loaned so that you can be able to reach the requirement for you to trade. And this was the door that was opened for retail traders so that they can be able to trade in the financial industry through the retail brokers. So the amount of leverage you use will depend on your broker and what you feel comfortable with. The amount of leverage you use depends on your broker and what you feel comfortable with. So typically the broker will require a minimum account size, also known as an account margin or initial margin. Once you have deposited your money, you will then be able to trade. The broker will also specify how much they require your position or lots traded. So the broker will tell you how much you need and how many lots you need so that you can be able to trade in the market. And as we go on, we'll understand well, and you will understand. I know you will understand. For example, for every $1,000 you can trade one standard lot. So if you have $5,000, they may allow you to trade about $500,000 of forex. So the minimum security margin for each lot will vary from broker to broker. So there is a lot of brokers and they have different rules and different way of trading. And in the example above, the broker requires 1% margin. This means that every $100,000 traded, the broker wants $1,000 as deposit in your on the position. So some brokers describe their leverage in terms of leverage ratio and other in terms of margin percentage. The simple relationship between the two terms is leverage is equals to 100 divided by margin percentage, or margin percentage is equals to 100 divided by leverage. And leverage is conventionally displayed as a ratio such as 100:1 or 200:1 up to 500:1, and today some are in 1,000:1. Now you don't need thousands to trade. So meaning if a broker is offering 1,000:1 leverage, you need $1 to open a position, because it's $1 in your account multiplied by 1000. So at this point, this is what is in your account. This is your deposit multiplied by the leverage given by the broker. Then you'll see how much it will come. Then it will categorize you at the category you are. Maybe you have $1 in your account and the broker is offering 1:1000. So you see it's $1 multiplied by 1000 is 1000. So as we remember, 1000 is the micro account. So with $1 you can open a position, because we have three categories. We have standard lots, we have mini lots, and we have micro lots. And one standard lot is $100,000. Divide by 10, you get $10,000. Those are mini lots. And $10,000 divided by 10, you get 1,000. So with $1 multiplied by the leverage given by the broker, you will see that you will have 1,000, and 1,000 it qualifies to open a position because it meets the criteria of $1,000, which is the lowest as you can go in the financial market. Now, which now meets the minimum deposit of $1,000 or 0.01 micro lots. So if it's 5 or 500 is to 1, means you need $2 to open a position, because it's 500 multiplied by 2 is 1,000. So you need $2 to meet the criteria, so that when it reaches 1,000, it is enough to open a position, because the broker, it has the last category of micro lots, which is $1,000. So the leverage they gave you multiplied by your deposit to meet the criteria. So if you deposit maybe $10 and you have a leverage of 1,000, it will be 10,000. So with your $10 you can open a position of 1 mini lot. So as we go on, we'll understand much. So you need $2 to open a position, because it's 500 multiplied by 2 to get 1,000, which means the minimum of one micro lot is met. But still, you can't open a trade now. You need to know the requirement margin for every position. The broker needs commission and enough money to protect your trade from going to negative. In the event that the money in your account falls below margin requirement or usable margin, your broker will close some or all open position. Now you can see, even if the broker has given you the leverage to boost your deposit to meet the criteria of trading and to open for you opportunity, still the broker is very, very keen when it comes to position opening. They will manage your position. They will tell you how much position you can open, and without forgetting that there is some charges which are the commission, which we said they are the main drivers of the broker. They have to have their cut when it comes to position opening. There is a commission and there is swap fee. If you have an overnight trade, it has to pay some money when it comes to swap fee. That's called swap fee. So the broker then it has a mechanism to protect itself. So when you go on a particular loss, they will close down your position to protect themselves and to protect you, so that your account should not go negative, because the broker will have to go in the pocket to protect you, which they don't want to do that. It is not good even. So when you are in loss, they will close your positions to protect themselves. So this prevents your account from falling into negative balance, even in a high volatile or fast moving market, like maybe a gold XAU USD, which is gold. You will find out that you only need like $7 in leverage of 1:1000 to open a position and get a warning if your position is -3, almost to close itself. So you'll see some pairs are so much expensive to deal with them, and still it is favorable because we have a high leverage. With high leverage, meaning that we have a bigger loan to risk. But if the leverage was 1:500, now you could see this is supposed to be double. You need $14 for you to be able to trade maybe gold. So let's go on. Maybe for Euro USD, you need $1.5 and a leverage of 1:1000. So you know 1.5 multiplied by 1000, the answer you get, that's the amount of money you are moving in the market. So you meet the criteria. So in your account, and margin warnings is at 0.58. So you need very little to access the market. You can see with 1.5 you can access the market if you have a broker that is offering 1:1000 leverage. When looking for, you can see leverage is much important. So this is one of the doors that was opened in the financial industry. The leverage is very, very important. So the lower the leverage, the bigger the deposit, with a small room for trade to go against you, and the bigger the leverage, the lower the deposit, and bigger room for a trade to go against you. So you can see if the leverage is smaller, now you have to deposit a lot of money for you to even to open a position. And when the leverage is bigger, now is a very bigger room for the market to go against you, and you need a little deposit. So example, you have $10 in your account and a leverage of 1:400. So your account has a power of 4000 because it's 400 multiplied by 10, you'll get 4000. Now the account has a power of 4000. As we said, it's deposit multiplied by the leverage. Now you open a 0.01 micro position, which now you can open, even you can open 0.04, but you can't open 0.04. As we say, the broker must protect itself. Maybe you open a position of 0.01 micro position, your account will send warning around a -$4 and maybe close. You could see now you don't have a bigger room to go the market to go against you. You don't have a bigger room for the market to go against you. So if the market happens to reverse to the direction you predicted, you'll have to deposit again. And example 2, you still have $10 and a leverage of 1:1000. Now you have 10,000 power. The leverage multiplied by the deposit, now you have a power of $10,000, which means you can open a position of mini lot, but you can't open because the broker has charges and swap fees, and you need a stop loss, because what we measure is how much the market can go against you. So when you open a position of a micro position which is 0.01, your margin call warning would come around -$9. Imagine this one is -4, but this one is $9. But if the market reverses at -5 or 6 as the same trade, maybe it reverses maybe from the same trade which was -4. If you are -4, it is it wants to close down your position, and the same market with a leverage of 1:1000 reverses at $5 or $6. It reverses on your predicted direction. Now you are very strong. Why? Because you had a very bigger room for the market to go against you. So, but the other trader have to deposit again to get back in the market. This trader number 1 with the broker with the low leverage has to deposit again compared to the one which has the bigger leverage. Now you can get the logic. So I have the best broker in here, which I have done my research and used them, and I still do use them. The IC market with a leverage of 1:1000, and we have FP market with a leverage of 1:500. Now from this part we will make a shift from here and go to the next part, which connects us with the market. This is the IC market with a leverage of 1:1000, and we have FP market with a leverage of 1:500. So you could prefer the one with 1:1000. You need a little to deposit, and here you need more to deposit. So the margin calls here will be more, and here will be less, because you don't need much to move the market. Now my friend, at this point now you understand. Now we have been opened doors by the retail brokers. They have introduced a mechanism called leverage. It's a mechanism that seems like it is giving you debt using ratio, so that you can be able to trade the market. So the leverage ratio that you are getting from your broker, you multiply with the deposit, and you'll see how much you could need for you even to open a position. Now you can see. Now let's go on to the next lesson, and we see what we gonna gain from it. Thank you very much. Consider subscribing, and make sure you ask question and like. Thank you.